Welcome to Sell-Side M&A Options, Closing the Deal. This session is presented by BDO, Griffin Financial Group, and SES. Let's meet our panelists. Eric Farr, Partner, Transaction Advisory Services, BDO. Ken Baker, President and former owner, New Age Industries. Mike Pantaleone, Partner, LLR Partners. John Lee, Senior Managing Director, Griffin Financial Group. And your moderator is Ed Reniger, COO, SES ESOP Strategies, a Stevens & Lee Griffin company. Take it away, Ed.
John, hi. Thank you for joining us today. I suspect that many people in the audience may not really understand the process of what it means to take their company and actually sell it. For many people, it's the first time in their life cycle that they ever would have done something like this. So maybe you could spend a few minutes sharing with the audience kind of your process, the auction process, as I understand it, of how they sell the company. But maybe even before you jump into those details, we are in the middle of a pandemic now, and the conventional wisdom may be that it may not even be a good time to think about selling your business at this time. So before you kind of go through your process, if you could give me your thoughts, give the audience your thoughts on whether now is a decent time to even consider selling the business.
Yeah, thank you, Ed. And it's certainly a good question. This has been a challenging year in many aspects, and you would think off the top of your head, and I think logically, that selling a business, mergers and acquisitions in general, this would not be an opportune time to do so. And indeed, I think the top line numbers in terms of closed transactions are about 20% off of where they were at this time last year. But perhaps somewhat surprisingly, what we've seen, since, say June on, is actually a fair amount of transaction or M&A activity. And it's I think, commonsensical for companies that have continued to perform well, or at least perform as they typically have through this recession. And also those that are in industries where purchasers are still flush with cash and willing and able to do acquisitions. A lot are getting done. I can just tell you anecdotally from my experience, we had 5 clients going into March, going into the first pandemic month. And we've since found that 4 of them either closed or are well into the process of selecting buyers and closing. So again, that's anecdotal. 4 out of 5. The 5th is indeed pandemic stricken, if you will, and is waiting for better days, hopefully, next year. So things are getting done again if the company's performing and the industry has purchasers that are willing and able to do so. In terms of the process, when you are a seller and you're a business owner, and we only work with privately held companies, family business, owner operated, or partnerships, we are engaged by those companies to sell them in what we would call a competitive auction process. It's all confidential. We prepare a information memorandum, or a book, as we call it, which is basically contains all the information that a buyer would need to make an informed opinion on valuation and a judgment on it. So it's history, it's market, products, services, employees, suppliers, facilities, all in a nice package. And then we manage a process with, it could be 200 potential buyers, it could be 5 potential buyers, whatever sort of makes sense. And sort of have a calendar, a timeline, once those purchasers receive the book, under which they submit their offers of interest or not. And it's, sort of built a bit of military precision, if you will. There's 3 weeks, they submit their initial indication of interest. We look at those proposals. We then sometimes narrow that down to buyers that get to continue in the process. And we then have management meetings and data room access and provide more data, and ultimately then get second and sometimes even third proposals, depending. And all the while, we're making the purchasers more educated on the business, such that the quality of their offers is fully reflective, of that data. You've heard the term garbage in, garbage out. The less you give somebody, the less valuable their offer. The more you give them in terms of, information on the company, the more valuable and meaningful that proposal is. And the whole point at the end of the day is to arrive at a place where the valuation is acceptable to the seller, to the client. The buyer is acceptable for a whole bunch of reasons, typically beyond valuation. Corporate fit, strategy, continuing nature of the business or not. Whatever is a whole basket of features that are important to sellers, even well beyond valuation and whatnot. And then you're highly certain at that point that when you select that purchaser that went through that process, that they're not going to find anything that you haven't already told them. It's sort of a confirmatory, if you will, versus exploratory due diligence or closing process. And so you're highly certain that the terms you agree to are the terms you're going to close on. So that's sort of a summary, if you will, of the kind of sale process that we would manage for a business.
Very helpful. Eric, moving over to you for a few moments here. So John talked about the auction process and that, the theory of going out to, I guess, to a broad market, however that's defined for that specific client, can help drive value in some fashion. I guess that's really the kind of the point of the auction process. But before that, what are some of the things that you can do to help your clients prepare for the process, and what sort of value do you think that brings to the seller in that process by doing some pre-transaction planning with you?
Sure, that's a great question, and it's we tend to be very complimentary with John and investment bankers with the sale process. We look at it kind of like a dress rehearsal. We'll do the same thing that the buyers will do in terms of a due diligence exercise, both in financial and tax. And it really creates a collaborative environment for everybody to be in a friendly way going through what they're going to go through just before you begin the sale process. So it's very much the same thing that a seller would be subjected to, except we're doing it in a friendly environment. So the value drivers behind going through the process in advance, I kind of put it into four buckets. The first one is it's that dress rehearsal. So we're going to ask the same questions that buyers will ultimately ask. And so since we're asking them up front, it makes the management team smarter in their responses. They look like they understand, not that they don't understand the business to begin with, but when a buyer's asking detailed questions about their books and records, if they haven't gone through the process, they might stumble a little bit having to find the details, and it won't be top of mind. So we just, going through the process, find that the management teams are better prepared to answer those questions. And oftentimes when you have members of the executive team that are going to carry forward with the business going forward, there's a little bit of them selling themselves in the process and being a little bit smarter about the questions that are going to be coming to them helps position them a little bit better post-transaction. The second one that I'd say is surprises hurt a process. So if a buyer is going through the financial information or the tax information and they identify something that wasn't provided to them up front, it creates a pause in the process, a pause in their thinking. And what ends up happening is they lose confidence in the underlying financial or tax information. And that might actually make them second guess their valuation assessment and might actually have some value erosion. The third one I'd say is, these auction process that John described, there's a lot of different bidders that John's going to want to keep in the process as long as possible. Granting exclusivity is probably the last thing that John wants to do. So he'll hold that card until the very end of narrowing down those bidders. What that means is that the management team, and these are often thinly staffed management teams with maybe they didn't even feel comfortable reading some of their secondary layer of management into the process. So they're having to do all of this preparation and interactions with bidders and run the business at the same time. So going through and having, for example, a BDO branded quality of earnings report helps those bidders get up the learning curve quicker and without burdening the management team's time. So everybody's going to ask similar questions. So if you can answer the majority of the questions through a document that they don't have to burden management's time, they're still going to want to ask questions, but those questions that they'll ask will be smarter questions, and there won't be as extensive of those questions. The last one is, and we see this not on every occasion, but on a lot of occasions, and John can probably speak to this. You know, businesses have things that happen to them leading into a sale process that management would say, those aren't normal things. For example, COVID that's going through now, even if a business wasn't overly affected by COVID, we're seeing plenty of businesses that had a little blip. They had 2 months of activity where things just kind of went a little bit haywire. And so having an accounting firm like ours help a company, what we can do is analyze what those trends look like and have adjustments that help position the historicals to match up to the story that John's telling. So John's going to tell the go forward story, and it's nice if somebody has matched up and married the historicals to be the launching point for that prospective. The last thing I'll kind of highlight as an example of one of the things I said was a value driver is, and my tax colleagues would probably appreciate me doing this. Although I'm not a tax person, one example is we see a lot of S corps that are looking to sell as far as a tax entity structure. And a buyer is going to find that appealing because they often can enter it into a transaction called a Section 338H10. And that election provides certain tax advantages to the buyer post-transaction. But the S corp is a very fragile tax entity structure. And so a buyer is going to go through a process with their tax advisors to make sure that there was nothing tripped up in the S corp election throughout its entire history. And as John can probably attest, a lot of times you go through the entire exercise and the buyer was planning on doing this 338H10 election to get certain benefits from a tax perspective. And at the very end, their tax advisors say, oh no, the S corp is invalid. And all of a sudden, this item that otherwise should have been a non-issue becomes a huge issue. And the transaction either gets significantly delayed or it gets derailed. And that can be easily prevented by doing a little bit of work up front. The other thing that if you did a little bit of work up front is there's obviously a value driver to the buyer in entering into that type of a transaction arrangement. If you let the buyer assess what that value is to them, then you might lose the value where you otherwise, if you had positioned it correctly, might have gotten some benefit to the seller. So those are some of the things that we traditionally see in helping our clients through that sale process and get them positioned well to maximize the value that they get from the proceeds.
That's excellent, Eric. Thank you very much. Mike, you're in a bit of a unique position here. You both buy businesses and you sell businesses in your role. So I'm curious to a couple things. One, I'm curious kind of your reaction to what Eric was saying and whether you see that as beneficial in a process when you're buying a company. Related to that, what are you looking for when you're out there buying a company, right? You bring a different perspective here than John, who's out there selling businesses. So what are you looking for when you're looking at companies and thinking about whether you want to make an investment in them or buy the company? Kind of the flip side of that, though, is right, at some point you're going to sell that company. It's not something you're going to hold forever. So kind of curious, and how early in your process are you thinking about an exit strategy? Are you thinking about how other buyers might be looking at the businesses that you might be selling? So if you can give a little bit of both flavors, it'd be really helpful.
Yep, we definitely live on both sides of the transaction at some point. And I definitely would echo a lot of the things that Eric was discussing in terms of value enhancers, because for us, we'll do thematic research. We'll try to be strategic about the businesses that we're looking to invest with. But at our core, we're a financial buyer. So businesses that have taken the steps to really get their data right, to really have a clean set of historical financials, are going to have a big advantage over somebody who's not made that investment, not taken the time to develop the metrics that show maybe the momentum that the business leaders feel, but have a harder time showing. You're giving a lot of credit to the potential buyers. You live with your business day in and day out. You know the story front and back. They don't. They've got a lot of catching up to do when it comes time to do a transaction like this. And I don't think that's always fully appreciated. So there can be a story about, hey, we've really turned a corner. I can feel it in the performance of the business. And the buyer, the investor will say, great, let me see. Where is that? Where can I see that? So it's hard to harmonize those things. And I think timing has a lot to do with, success or failure in a process. And I'm sure John sees this a lot with clients that are preparing to go to market and giving them the maybe counterintuitive advice of, I think you should wait a little bit. Get the story right. Get a couple proof points under your belt, whether it's a couple wins in a new market, whether it's a couple months of that increased efficiency that you're excited about. Have the proof points first. I think it's a little bit of an attraction for a management team to transact or try to transact when there's something on the precipice, when something's about to happen, things are going to turn. But it's really hard in most cases to convince a buyer or a set of potential buyers to buy in and maximize the value when that's going to happen. Even if you're just starting to shift the curve, having those couple data points behind you, having those analyses that you can point to that say, this isn't just something we feel really good about. We've done the work. We understand the metrics in our business, the drivers of our business well enough to see that these three things here indicate a shift like this in the business going forward. So if you pull that apart a little bit and say, well, what do we do once we get involved? We basically look to start the process of correcting for that or enhancing what's already been done. So we're going to be investing in team members, in systems, and most importantly, processes to make sure that there is one clean data set, that there's a nice set of financials so that when we hire Eric to help us with our sell side when we're on the other side, he doesn't have to do all of the work. There's a good set of financial information already prepared. And it's not just the financial statements. It's not just having a good set of historical P&Ls and balance sheets. Developing effective KPIs is so important, not just to sell the business, but to run the business and make sure that the team does have their finger on the pulse of the drivers of their organization, which may seem intuitive to them, but as the team grows, as there's more people around the table, especially investors, it's a helpful translator to make sure everybody's on the same page again about what's really going on and what's causing the business performance. So one of the things that we will try to do is really build out the finance department to be not just a reporting site, but a strategic portion of the business that's touching all of the functional areas, that's working directly with them hand in hand to make sure that they have the data to be making the right decisions for the company and that they are empowered with the right reporting capability to show where they're finding success and where they could possibly use help. So we're going to look for the team really and other outside factors to dictate when is the right time to sell a business once we're already involved. The adage that we go by is it's a lot better to be bought than sold. So if you're doing things right, if you're growing quickly, if you're being annoying to a competitor, that's perfect. They'll come to you and initiate a process through inbound strategic interest, one of John's, I'm sure, favorite phrases to be kicking off a process with. If you have a few bidders around the table, creating that competitive tension is a lot easier than if you decide somewhat arbitrarily, I think it's time to sell the business. Let's go tell everybody about us. So you'll look for those factors, but make sure that we're living by our own, rules and make sure that we've got some of those proof points. We've got consistency and that we're making our way up the curve to have a story that makes sense, an easy to buy into story that buyers are going to get excited about. So I think the last thing that you asked about is when do we start the process of thinking about the sale? And this is another one. It sounds counterintuitive, but we start thinking about that before we actually make the investment. That's actually part of our diligence process, to be thinking through where is our potential investment target situated in the market, who are today's competitors, and who are the natural acquirers, who are the upstream strategic purchasers that should find this business most interesting. In an ideal world, it's a pretty intuitive step function. You've got sort of pure play, best of breed types of players sitting below higher level platforms that are natural aggregators in a space. When you have that type of linear dynamic, it's an easy process to say, okay, I understand what we're trying to build, what those types of buyers typically find attractive, and we can mold ourselves to that. When you're creating a market, or if you're in a situation where it's so niche that there really isn't a natural acquirer, that's a risk that has to be factored into the risk reward calculus that ultimately informs our valuation. So we're going to be doing that review work before, certainly during and leading up to the exit process itself. All the phases of a potential investment, we're thinking about that and building something that as many parties as possible are going to find interesting, so that we do have competitive tension in a potential exit process. But man, it's hard to figure it all out up front. I think if we did a retrospective on, how many situations has LLR been in where we correctly identified the eventual buyer of our investment, I bet it's not more than 50%. So sometimes sometimes you can have the right thought process of where a company is going to be going over the course of what's usually about a 5-year hold for a company like mine, but a lot can happen. So we're always thinking about it, but not always right.
Thank you very much, Mike. That was helpful. Ken, now let's turn to you for a few minutes. We haven't had a chance to really talk about your experience, which is very different than what we've heard so far. What we've heard so far is focused really on third-party sales, but you chose a very different path that many people may look at as less conventional. And you ultimately sold your business over time, if I understand correctly, to an ESOP for the benefit of your employees. So maybe can you educate the audience a little bit? What is an ESOP? Why did you decide to go in that direction? And then finally, if you can touch a little bit on value, there may be a perception out there that, selling to an ESOP might be less attractive from a selling shareholder's perspective as far as value goes. So I'm curious to get your thoughts on that.
Okay. Well, an ESOP is a employee stock ownership program. It was set up by the Congress through the ERISA law back in the 70s by Russell Long. And I'm very familiar with the Subchapter S ESOP, which is you pay your taxes through the selling shareholder or through the shareholder. An ESOP, I have sold 100% of my shares over 15 years in 4 different tranches to the ESOP. And it is a separate organization. It's really a trust, if you will, and the employees have a piece of that trust. And it's a structure where it's the ownership of the organization. It has nothing to do with the management of the organization. The ESOP owns 100% of the organization. Now, because of that, as part of the law, that makes New Age 100% tax-free. Pennsylvania state tax and federal tax. So we pay no federal tax whatsoever to the federal government or to the state government. And if we had to pay taxes and we weren't a 100% ESOP, we would be paying $14 million this year, which is a lot of money. And so with that type of situation, what do you do with all that extra cash? You can expand the business, which we are doing, hire new employees, buy more equipment, and expand the business. So it's a one. Personally, I think it's the most tax efficient business model ever made out there. And I think it's probably the best business model out there, because what it does is when you have people who are owners, it's different than employees. They actually care more about the business and they start engaging in the business. They start making improvements in the business. And as I like to tell my story, that Ed has heard before, where I do MBWA every day while I'm walking around the building. We have a 244,000 square foot building. I say, good morning. How about those Eagles winning last night? And happy birthday. And I see one of the fork truck drivers laying a patch spinning the wheels with the fork truck. And I go up to the fork truck driver and I say, why is it that you're beating up your fork truck? And he goes like this. And I say, here's a better question. Why are you beating up Joe's fork truck? Because he owns 100% of that fork truck. And his head goes down. It's a different conversation. They own everything in that plant. They own the scrap. They own the equipment. They own the rack that they may run into. And they want to be good to the company. So talking about the value, the ESOP will only pay financial value for the company. So if you do sell to a competitor, you can get strategic value. 1 and 1 equals 3. There's no question about that. However, if you do it the way I've done it, where you start earlier and you do multiple tranches over the years, and you teach the team members how to make money, and the company does progress, you can possibly get strategic value. Now, our share price over 15 years has gone up over 1,100%. So I feel I've gotten strategic value for my shares. Now, one very important aspect of doing it in tranches is I've sold 49% of the company back in 2016. So I sold 49%. I still held on to 51%. So I took 49% of the value of the company off the table, and I still had total control. I could still have sold it to a competitor, multinational, or private equity. What other business model can you do that with? So it gives a total flexibility to the selling shareholders to do certain things. And what it also does is it solves a lot of other problems, which is when an owner does sell the company, what happens to the legacy of that company? What happens if the company is moved from the community that it's been there for 30 or 40 or 50 years to Mexico or North Carolina or who knows where? Those are very important issues. And what about the long-term team members that have been with you for 20 or 30 years? How do you reward them for doing a great job? The ESOP solves all of those problems and then some, because ESOP actually makes more money, bottom line, 8 to 10%. And that has been proven over the years. And also better retirement plans by 2 to 3 times as much. We have 16 millionaires working at New Age right now out of 200 employees. And that's only 15 years of the ESOP being around. So overall, I think it's really the best business model out there. And the problem is guys like me don't know about it. It's awareness. It's really business brokers are really talking about selling to the competitor or private equity or large multinationals, and ESOP isn't brought up, and it should be brought up because it's, as I mentioned, it's very tax efficient. It supercharges the organization. It becomes more profitable. It takes care of the employee, so it solves income inequality, and the company doesn't move, so it's good for the community.
Thank you, Ken. So a couple more questions as we wrap up here in the last few moments. We've heard a little bit of talk about management so far, and I'm kind of curious, John, from your perspective, and Mike from yours as well, on kind of what's your view of management? How important is the management team in the sale process, as well as kind of the running the company after you acquire? John, maybe if you could.
Yeah, well, management and the makeup of the management team is vital, and it can range from anything. I mean, sometimes the owner is the CEO, and maybe 70 years old and wants to retire, and there really isn't a good number 2 underneath him. And in that case, what it does is it limits your buyer pool, right? Because then you really can't go to private equity typically, because they need a management team. Private equity does not want to run a business. So you're really going to limiting your options to your competitors. On the flip side, if the management team is either not owners, the owner's passive, or they own, a smaller sliver, or they only want to sell a piece of the business and keep running it. Well, now you've also set the table for, a private equity type investor who typically would like to have management skin in the game. That is equity ownership after the sale. And then, of course, right throughout the process, you need management to help sell the business. They're the ones that know it best.
Yeah, and I would echo almost exactly what John said. It's extremely important from a private equity buyer's perspective. I thought the perfect summation is we can't run a business. That's not our business model. In some cases, we may have an executive that would be useful at the board level or somebody that could be an advisor. We at LLR have built out a bench of resources to enhance our management teams. But when there's not a core group that does know the business, that is interested in trying to achieve that next step of value with us, it's really a lot harder to get a deal done. And that's what creates some disconnects in situations where someone's looking for a full liquidity or very vast majority recapitalization. So they're selling you on how great the company is, how big the opportunity is going to be, and why you should be really excited about paying for it. And you say, that's so exciting. How much are you sticking around for? They say, none. We're actually selling. Not as easy if you say, okay, we're actually taking some liquidity because of whatever reason. There's any number of reasons that somebody would want to diversify or take some liquidity that they've earned over the course of building their company. But it's a lot easier for a private equity firm to hear, and I'm so excited, I'm going to roll this big chunk of my proceeds to that next stage. So you can't say enough about the importance of management and human capital in general from a private equity firm's perspective.
Thanks, Mike and John. So one last question. I think we have time for one last question. I'm going to, sorry, Eric and Ken, to cut you out of this just a little bit, but I'm going to ask, again, John and Mike, a little bit about sizing. John, if you could just give the audience a little perspective on what size businesses make sense for at least when you're running a process, and the flip, Mike, what you're kind of looking for when you're thinking about investing.
Yeah, so our typical clients, I'll go to earnings first. And the typical earnings metric that we use is EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. Most of our clients were kind of lower middle market, so 5 to 15 in EBITDA. We will take things that are a little more exciting, maybe if they're down to 2 of EBITDA. For the people that are listening here, maybe that translates to 20 million of revenue as a minimum, up to several hundred million of revenue.
And very similar set of parameters for LLR. We're a lower middle market growth equity fund. So when we're partnering with businesses, they typically have, call it $15 million of trailing revenues, up to maybe 100 million on the highest end of the businesses that we're getting involved with. And when a company's raising capital from a growth player like us, they may or may not be profitable. So having a proven business model, having some profit makes it easier, but it's not requisite for someone like us to get involved. But just this summer, I've completed transactions with a company doing $1 million of revenue and $4.5 million of revenue. And that's because part of our strategy of value creation is through M&A. So when we invest in a platform, there's always an organic growth story, but we like situations where we can complement that with inorganic, with acquisitions and things that either build out the product, give us a different geographic coverage, or in some cases are going to bring additional talent into the company. So we really do cover the whole spectrum of $1 to $100 million of revenue scale in the industries where we're most active.
Excellent. Thank you, Mike. Yeah, go ahead, Ken.
Yeah, Ed, I wanted to comment on the size of the optimum size floor, if you will, of an ESOP candidate. So we like to look at, let's say 25 employees at least, and EBITDA of $500,000, let's say $750,000 up to $1 million, because there's going to be a loan. Those are kind of the acid tests of it. ESOP really doesn't work for very small companies because there's going to be a loan, and many times a smaller company can't handle the loan, and it's got to be profitable on an ongoing basis because you have to pay back that loan.
Excellent. Thank you very much, Ken. Listen, I think we're basically out of time here. John, Eric, Mike, Ken, really appreciate all of your time. Really appreciate sharing your knowledge with the audience. And I hope everyone sticks around because we're going to have a short Q&A with the entire audience after we wrap this up. Thanks again. Have a great day.
Thank you, everyone, for listening to our pre-recorded session and joining us for this live discussion. We really appreciate the questions you threw out there. So we talked amongst ourselves a little bit, and I think what we're going to do, since we had 3 ESOP-specific questions, we're going to start with the other 2, and we're going to lead it off with John. John, if you don't mind, and Eric, you can chime in as well on this one. After John speaks up, if you have some additional comments, it'd be greatly appreciated. So, how early, John, should someone start running their business like it's for sale? Again, John and Eric.
Thanks, Ed. And look, not to be cute about this, but how about today? And I say that again, not joking, but oftentimes when we meet a client or a prospect, they're like, "Hey, here's a business now, okay? But if we did X, Y, or Z, it could be a heck of a lot more valuable, and I want to be paid for that." So the question is, well, why didn't you do that? And it could be there. I could list out, almost an infinite number of examples. If we had a better sales force, if we introduced this new product, if I had a management team, to replace me, whatever it may be, that's something that would be valuable if you've done it. And, maybe you get some credit for some of that, but if you're running the business today as if you're going to sell tomorrow, even if you're not going to sell to 10, 15 years from now, it's going to increase your value. You have runway to explore those options. And, I'd say, and I'm pretty sure Mike would back me up on this, that the minute he buys something, he's already thought about how he's going to sell. You heard that just now on the panel discussion. Why wouldn't a, sort of non-institutional, traditional owner think the same way?
To add on to that, to John's points, the trailing 12 months becomes the important piece for the financial metrics. So as soon as you can start operating it with that mindset that folks are going to be supremely concerned about that trailing 12-month period, the better. And I'll give you an example. A lot of times we'll go into a business, maybe they're a manufacturing business, and they want to get credit in their EBITDA, their earnings before interest, taxes, depreciation, amortization, for cost takeout measures. And it's always a stronger argument to support an EBITDA adjustment if the cost-cutting measure has been implemented. And it's even stronger if you have a couple months or more of track record showing what the fruits of that cost takeout measure has done on the business. So it's demonstratable. It's less sticky in terms of an add back to your EBITDA if it's on the come. And so that would be my feedback on to John's point. If you're thinking about selling, start today.
Thank you, Eric. Much appreciated. And just for everyone, we don't have a ton of time here on these questions, but there are 20 minutes where we can go live with everyone to ask questions. So to the extent we're not able to answer everything in this short 5 minutes that we have left here, we'll get to all of those questions in the group Q&A later. So please stick with us. So Mike, a question for you. And as a buyer of companies, I think this is probably perfect for you to tee this one up here. So what's the top mistake people make when preparing to sell a company?
Yeah, I think the hardest thing to get over is when you don't appropriately anticipate the key questions that a buyer is going to have about your business. And this again gets back to the familiarity that you have running it and the catching up that a potential buyer is going to have to do. So something that you may have come to live with, understand perfectly, a nuance, a quirk, whatever it might be, someone's going to have a lot of questions on and going to need analysis to get more up to speed and comfortable with the dynamic. So when you haven't fully thought through what questions is somebody going to ask and how can I get them comfortable with this nuance in my business, this dynamic in my market, that can put you into a bad spot. And I think that the mistake that compounds that is when you're over-indexed to solving that with a story, to explaining it rather than being able to show through analysis your understanding the mitigation strategy or your ability to get around whatever that quirk is. And whether it's customer churn or a competitor or again, some other dynamic, the more work you can show, the more analysis and thoughtfulness around the topic that you can demonstrate, the more comfortable you're going to be able to get that person on the other side of the table who is playing catch up, who's trying to get up to speed, comfortable with the construct.
Great.
Hey, Ed, I'd like to make a comment on that question. Let's elongate that question. What is one of the biggest mistakes when you go to sell your company? And one of the biggest mistakes, I think, is not considering an ESOP, not considering selling to the employees. A lot of people think, I got to sell to my competitor. I got to sell to that private equity company that keeps on bugging me, or the multinational, or Michael, who has his business brokers always calling me. So the ESOP is an option and should be put on the table and be evaluated along with these other options, and really consider, excuse me, the not only the financial aspect, but what will happen to the company when it is sold. And here are two questions that I think that a selling shareholder should say. What are my nightmares of when I sell it, after I sell it? What is my biggest nightmare? And here's the other question. What is my biggest dream for my company after I sell it? And really try to work that through your head, those two questions, and really think about them. And I think that the ESOP should be put on the table. It's not for everybody, absolutely not for everybody, but it is for many people who don't know about this. And there's plenty of people around that know about ESOPs, and I think Ed knows one of them. He knows about ESOPs. And so I think that's one of the mistakes that selling shareholders don't do.
Thank you, Ken. So we're going to wrap this up now, and we're going to go over to the Meet the Speaker session, and we'll finish the rest of the questions we didn't get through and any other questions people have. So we're going to click the link now and join you all in the Meet the Speaker session.
Where's the link?